Good morning. Welcome to Windsor Brokers live market outlook for Wednesday, 19th of October 2011. The headlines of the previous 24 hours since we had our last update come from Spain, where the rating agency Moody's cut Spain's credit rating by 2 notches. Widely expected. I think with the highlight on the previous day announcement of the agency, when they actually warned France that its AAA rating could be at risk due to the current crisis. This increases the pressure on European leaders to make rapid progress in solving the regional debt problem, as Greece is still number one, and currently this week is in heavy strikes. So the people are definitely not happy with the tough measurements that the government is undertaking to take the country out of the current crisis. However, the possibility of spreading a crisis through the neighboring countries, especially two biggest economies in the Eurozone, such as Italy and Spain, is now increasing, despite some positive rhetorics coming during the past week from first Franco-German meeting, top meeting, when announcement was made that they are ready to take some stronger and firmer steps in order to tackle the current debt crisis. Also, the previous weekend's G20 meeting reiterated these things. However, this was still rhetoric, and no firm ideas given yet, no steps and no confirmation what are the steps going to be. However, this is not a secret. It's well known what each government has to do, and especially the European Central Bank and the Eurozone leaders. They need to take some more serious and more firm measurements, as they were blamed by the UK Prime Minister that they react a little bit, always a little bit too late, and a little bit not enough in order to handle the problem. The other thing that is now pressuring the market was actually Monday's actually comment of German Finance Minister Schäuble, when he basically poured the cold water over the investors, saying that the picture is not that bright as it looked initially when the announcements came, as results to be reached actually to start moving from the current crisis. It needs a lot of work, and it's not a magic touch to change everything. This actually cooled a bit the markets. However, the euro still holds quite positive tone after yesterday's dip lower, and is still handling the recent positive outlook from the 9-month low at 191.35, while most of the instruments actually are awaiting the Sunday's meeting of the Eurozone leaders, when all the problems will be on the table and discussed, and likely, hopefully, to find some workable solution to start moving from the current very bad situation for a whole Eurozone, and not only Eurozone, but threatening the spreading of the Eurozone crisis, threatening the rest of the world, the big economies and smaller economies, in case of spreading. Also, the currencies, the commodities are still holding stable, also awaiting the 23rd of October meeting that will give us some more clues what are going to be the next steps. Important also to mention that France and German officials agreed, this was unconfirmed news, to leverage the Eurozone bailout fund to over 2 trillion euros in order to have always available funds for either recapitalizing banks or helping the government, such as the Greek government. However, the latest news confirmed that there was no agreement yet reached on scaling up the size of the Eurozone bailout fund in order to better handle the debt crisis. This was announced by senior European Union officials early this morning, and basically dismissing the report of agreement to leverage the EU bailout fund that was actually published in the Britain's Guardian newspaper. So this is still unconfirmed. Actually, it's been dismissed. So the increase of the fund to the required level, if you remember on yesterday's session, I mentioned that they were operating with a number of approximately 2 trillion euros that would be suitable, and it would be a good amount to handle the crisis properly. Now we'll see what will be developments, and all eyes are turned towards Sunday's meeting of Eurozone officials, when the more clear picture will be shown, and we'll see it on Monday, early Monday Asian session. We'll see the results of this. Brief look at today's calendar. At in approximately 45 minutes at 8 o'clock GMT, Eurozone current account. Forecast for today shows the shrinking of the current account gap to 7.3 billion euros compared to the previous one at minus 12.9 billion. Next one to come in 8:30 is MPC, latest MPC meeting minutes, where the voting is expected to stay unchanged from the previous meeting, where it's 009 forecast for today. Later on, from Canada leading index due at 12:30, increase on monthly basis, increase of 0.2% forecasted versus the unchanged the previous release. And the US building permits expected to decrease slightly to 0.61 million versus the 0.63 million previous release. CPI from US due at the same time, 12:30, expected actually to narrow monthly 1 to 0.3% compared to the previous month release at 0.4%, while core CPI on monthly basis is expected to stay unchanged at 0.2%. Housing starts from US sees the 0.59 raise, 0.59 million raise in the housing starts compared to 0.57 million the previous month release. And at 14:30 GMT, the US crude oil inventories raise of 1.3 million barrels is forecasted for today's release. Now let's take a look on the markets and see the latest developments in the major currencies and the commodities. Starting with euro, yesterday's actually the 17th of October upside rejection at 139 zone has dipped through initial and strong support. Actually, that was seen as a break point at 136.84. Extending losses down to 136.52, which is also close to 38.2 Fibonacci retracement of the broader uptrend from 131.45 up to 139.13, where the temporary support was found. The current recovery is showing still good strength, as the clearance of the yesterday's high at 138.16, extended gains up to 138.39 so far, and turns the focus higher. Current near-term pullback on the overbought conditions should stay above 137.30 zone in order to maintain the recent near-term uptrend from 136.52, with the hourly 20 days moving average currently at 137.50, maintaining the recent gains. Studies are still positive, and likely break above 138.39 on the upside to focus levels at 139, 139.13, and then our support at our resistance at 139.35, which is the 15th of September high. However, the wider picture still sees the upside capped while 139.35 and 139.40, the daily 139.40, the daily 55 days moving average stays intact. So holding below these levels keeps the broader bear trend in play. However, some more positive signals coming on the 90 days moving average breaking below 200 days, that actually the negative signals, pardon, that confirms the upside still intact for the pair, and keeping the broader bear trend from 145.48 still in play. So basically we need to see clearance of 139 and 139.35.40 in order to resume the recent uptrend, the short-term uptrend from 131.45. Otherwise, it might signal the double top here and the possible extension lower. The British pound. The British pound, the pullback from 158.51 high of 14th of October was contained on the downside by Fibonacci 38.2% retracement of the uptrend from 152.71 up to 158.51 at 156.30, ahead of current bounce higher. Clearance of 157.20 initial resistance, and brief break above yesterday's intraday high at 157.72 has so far seen 157.77. And it's basically looking for a further stretch higher to test initial barrier at 158.00 and then 158.21. The hourly studies are still weak but improving. We can see that MACD is attempting to break above its midline, but negative tone would persist on the short term as long as 158.51 stays intact. So the recent strength is seen short-lived while 158.51 intact. Break of 158.51 opens 159.40. We can see it on the daily chart, which is the Fibonacci level 50% retracement of the broader downtrend from 166.17 down to 152.71, where also comes the 55 days moving average in this zone on the daily chart. So holding below 158.51 keeps the immediate pressure to the downside, while clearance of 158.51 to signal further gains towards our key short-term barrier at 159.40.60, where is the Fibonacci retracement and 55 days moving average. Daily outlook is still maintains the negative tone as the studies are under their midlines and the moving average is pointing lower. The short-term uptrend from 152.71 and the recent bounce from 156.30 is for now supported by daily 20 days moving average that's currently at 156 zone, and while holding above this there is still scope for a upside attempt towards through 158 to test 158.51. Dollar yen stays within a very narrow range after some choppy trading and upside attempts that were initially capped by the main bear trend line drawn from 85.51, and current narrow range trades between 76.60 and 76.90 levels. The near-term outlook is still skewed towards the downside as the studies stay below their midlines, and the hourly 20 days moving average broadly caps the upside attempts. Basically, the pair trades in the directionless way, and the wider picture shows the extreme points at 76 and 77.30, where the 77.30 the trend line and 77.40.50 were at the previous highs. Expected break of either of the extreme points up or down to signal the fresh direction of the pair. Immediate supports at 76.60, 76.50 and 76.30, below which opens the key downside supports at 76.10 and 75.93, while on upside 76.90, 77, above which opens 77.30 the trend line, and then 77.40.50 the previous highs. The dollar Swiss is still in the recovery mode after hitting a fresh low at 88.79 2 days ago, with break above initial barriers at 90, initial barrier at 90.38, the previous high of 13th of October, extending up to 90.46, where they actually proving to be false break and the gain stalling at this point, and turning back to the yesterday's low at 89.44, where the temporary support was found. Current bounce higher needs to clear first 90.00 as the initial resistance and previous strong resistance, in order to expose 90.46 and then 91 and 91.20, the key upside near-term barriers. The outlook for dollar Swiss, however, on the short term remains in a way positive, while 89.20 and 88.79 holds the downside and sees some prospect for further gains, as the broader picture bulls are still intact, supported by main trend line, bull trend line at currently standing at 88.95. So basically, our main supports are at 88.95 and 88.79, below which would risk further extension lower or from the fresh high at 93.13, and likely to expose 88 zone where the 200 days moving average currently stands. On the upside, above 91.20, 91.40 zone, break here is required to refocus 92 and 93 respectively. The commodities hold steady, as I mentioned, awaiting actually the Eurozone's meeting on 23rd of October, when the more clear picture will be given to the investors what will be the next steps of the Eurozone officials in order to tackle the current crisis. The crude oil December contract is current front month is holding positive. Break above 50% Fibonacci retracement, extended the gains to 89.21. In a way towards, we need to see it on the daily, towards our key barrier at 90.57, break of which actually this was the previous consolidation range ceiling, break of which actually would signal some stronger recovery. Currently the daily 90 days moving average at 89.32 is capping the upside, and break here to expose 90.57, and above this we have 50% Fibonacci retracement of the broader 114.80, 17.494 downtrend, where also stands the 200 days moving average. It's around the 95 zone. On the downside, immediate support comes at 85.74, which is the low of yesterday, and then 83.37, the higher low posted on 13th of October. Holding above the later keeps the short-term uptrend intact and focus on the upside. Gold, as we can see, the recovery from low of 1532 posted on 26th of September still stays capped by Fibonacci level at 38.2 percent, with high reached at 1695 ahead of 1700. So 1695, 1700 barrier is our key upside target, above which to allow for stronger recovery of the recent bounce from 1532. Dips lower are so far contained above 1600 level. Going above the reduction in always I get might risk a test of 1600, 1595 recent range lows, which would be risky and likely to re-expose 1532 and turn the focus towards 1532. On the broader picture, we can see that market actually is moving within 290 days moving averages currently. As the break above 90 days moving average failed to sustain gains and returned lower. Current movements between 23.6 and 38.2 Fibonacci retracement of the downtrend from 1920 down to 1532 shows the gold entrenched within this range, with the downside limits at 1600 and 1595 offering strong support, while upside 1695 and 1700 need to be cleared in order to resume the recovery.